Okay, let's talk about an overview of managerial finance. And this is going to set the stage for the entire semester, essentially. What are we really studying? What are we looking at as we move through this semester? So, what's finance? Finance is concerned with decisions about money and cash flow. And again, you're going to hear this over and over again, that time has a money value, money has a time value, and the interaction of those two things will really drive the financial analysis for almost any situation. And so finance is concerned about how we make decisions with our money given time and risk and cash flow. So kind of taking those three components and putting them together and trying to make the best decision possible. Finance decisions deal with how money is raised and used, and we're going to spend a little bit of time on this here at the beginning and at the very end of the course. And then everything else being equal, more value is preferred to less, so that's a pretty obvious thing. You want something that's more valuable than less valuable. The sooner cash received, the more valuable it is. So if you think about it, there's that old Popeye thing where Wimpy says, "I'll happily, if you give me a hamburger today, I'll happily give you, $1 tomorrow." And really what we want is cash as soon as possible. So, if I said, which is more valuable to you, $1 today or $1 next year, from your perspective, you're going to say $1 today. One, because I get to use it for the next year. I can buy something and use whatever I buy on it, or I can invest that dollar and get, a modicum of interest on it. And so I'd rather have the dollar today than next year. Plus, between now and next year, I might not have the dollar anymore. I might, have gone bankrupt, or I might have a change in situation where you've essentially created a receivable for me. So you would rather have that dollar today than have that dollar a year from now. And so again, if you think about it that way, the sooner cash received, the more valuable it is. And these concepts are going to be mathematically proven out or mathematically analyzed as we go through. But if you think about the concept, it'll at least point you in the right direction on answers, kind of instinctive answers to the finance problem. Less risky assets are more valuable than, and I put preferred to in parentheses because sometimes they're not preferred. Sometimes people are willing to take the risk, but you got to be compensated for that risk. So less risky assets are more valuable than riskier assets. So getting something that's going to guarantee you $100 next year is more valuable than something that might pay you $100 next year. And if there's something that might pay you $120 next year versus $100 guaranteed, that's when we start looking at the risk. Okay, what's the risk that I'm not going to get the 120 if the 100 is guaranteed, and would I rather take the risk and get the extra compensation for it, get that extra 20 bucks? And so that's where finance, where the risk piece comes in, where we start looking at, hey, if I'm going to get more money, I'm going to be taking more risk. There's a higher probability that that money's not going to come the way that it's expected to. And so I need to be compensated for the fact that that money might not show up the way that I expect it to. So there's a few general areas of finance, and I'm going to move through this relatively quickly, but I want you to understand that finance happens in all organizations, governmental or private, and NGOs, or even in your own home. And so we'll talk through the general areas of finance, and you can equate this to what you see in your own workplace, what you might see at school or places you volunteer, or even in your own life. So general areas of finance, financial markets and institutions. So that includes the stock market, banks, credit unions, pretty much anywhere where you put money for investment, or where you get money from in a way of a loan, or folks that broker those transactions. So financial markets and institutions. Investments, I just mentioned them. Those are going to be things like stocks, bonds, mutual funds, derivatives, commodities that are used for investment purposes, certificates of deposit, savings accounts, etc. So those are your investments. Financial services, which include things like insurance. So insurance is really a bet between you and the insurance company that you're going to pay them a certain amount of money, and they're betting that they're not going to have to pay you back on a claim, and you're betting that something bad is going to happen. Now, generally, the insurance company is going to win that bet, which is why they're profitable. But that's a financial services company. You have other financial services companies that handle things like foreign currency transactions and auto and auto home insurance and additional life insurance. And so you've got financial services, managerial finance, which is how finance and financial decisions are made within a company or within your home. So really the smaller decisions around, and not small in the case of dollars, but smaller in the case of they're not large scale markets, that are around whether you do something or not, or what's given a choice between a zero interest loan for 60 months or a 2.9% loan, at 36 months, but there's a difference in the trade-in, or there's a difference in, or you get a rebate. Which one's the better answer? We're going to learn how to calculate that. And then you've got finance and non-finance areas, and again, this is something that I'll reinforce throughout the course. So you might go, hey, look, I'm taking this course because I have to, but I'm a marketing major. I really want to be in management, and so finance, I've got to take it, but I don't really like it. Let me kind of start with the understanding the principles will help you recognize that finance underpins almost all business decisions: marketing, management, accounting, production, information systems, technology. They're all impacted by general finance concepts. So if you get nothing else out of this course, try and understand the concepts, which we talked about. You've got the time value of money, you've got capital budgeting, you've got risk. If you understand those concepts and how they interrelate, even if you can't calculate it, you'll be able to understand how they interact with the decision-making process that your household or your business makes on almost every decision. So here's a few elements. So you've got, this is a typical mid-sized company, actually probably larger than mid-size, where you've got your board of directors. The president or CEO reports to the board. The board generally reports to a set of folks up here that might be investors. You might have sales, operations, as chief operating officer, chief financial officer, chief information officer, and then you've got some of these other elements. And everybody thinks, oh, finance, that's the CFO, and that's true. You got the treasurer and you've got the controller. So the treasurer basically handles cash, and the controller handles accounting. And this, again, being a little bit larger organization, a lot of times you've got an organization where the treasurer might be combined with the CFO and you just have a controller, or the controller and treasurer's functions are combined together. However, off the controller, you can see there's a few elements here: financial and cost accounting. So this is going to be the accounting not only for the books, so that what your profit and loss is and what you've gotten in basic accounting, but also cost accounting. So as you do production, for instance, or you're selling inventory, there's got to be accounting associated with the cost of that inventory, and that impacts decisions that's going to be made by the vice president of operations and the vice president of sales. You've got a tax department. So if you're doing business in multiple states, you're going to have multiple state tax exposure. So in what's called SALT, state and local taxes, you're going to be filing in a bunch of states. You're going to have tax exposure in a bunch of states that needs to be managed. You've got your federal taxes. If you're doing business internationally, you may have international tax implications, both here domestically as well as in the country in which you're doing business. So you may have a tax department as well. A lot of times those will report to the controller or report to the CFO, but they're going to impact decisions made by sales, they're going to impact decisions made by operations, and also potentially technology. You can see here that there's a dotted line from information systems into the CFO, and that's largely because the CFO is generally responsible for a lot of enterprise level reporting, essentially not just getting financial statements out, but also how are we performing relative to our budget? How are we performing relative to our bank requirements or our investor requirements? And because the finance function tends to get a lot of information, they're also tasked with analyzing it. And in order to do that, there's normally very complex accounting and finance systems associated with companies that would be of this size. And so the CIO works closely with the CFO to make sure that those systems are up and running. Additionally, in a tech company, which is my general background, the CIO is responsible for spending a significant amount of money. So the CIO and CFO work closely together because a lot of capital budgeting decisions, as we'll talk about later in the semester, involve getting input from the CIO as well. Over on this side, you can see that you've got a director of capital budgeting, and this again, I just talked about capital budgeting as it pertained to the technology, but you have capital budgeting generally over in operations, and that's determining, do I buy a piece of equipment or not? Do we expand this line? Do we decide to build out this product? What is that information? What information do I need? So they're going to be working closely with marketing. They're going to be working closely with the chief operating officer to be able to get that information out, to help make determinations at the board level and the presidential level whether we proceed or not with a certain project or product. Inventory managers. So again, we're going to talk a lot about where cash flow goes, but for businesses who have inventory, you could be incredibly profitable, but end up going out of business because you're not managing your inventory right, or it goes obsolete. And so decisions on inventory are generally, there's an economic order quantity calculation, which is we touch on briefly at the end of this semester, that essentially says here's the optimal amount of inventory to hold given rate of sales and rate of production. And then there's the credit manager. So every time you say, I'm going to give you $1 today versus $1 next week, that $1 today, remember, is going to be more valuable than $1 next week. And so you've got a credit manager who's assessing the probability that if you extend credit, say, okay, you can buy my widget, but you're going to pay me back in a week, that credit manager is going to be assessing the probability that you're not going to get paid back in a week, that it's going to be delayed out, or that the cash flow is going to be, or that the person is going to end up going bankrupt. Sales will always want to sell on credit. Sales' job is to get as much sold as possible, and one of the ways to do that is extending favorable credit terms. When you think about if you bought a car and they go, 0% financing or a great lease rate, that's credit. And the other side of that is there's a probability that you're not going to get paid back, and that's the credit manager's job to balance those two things. So you can see that finance impacts sales and sales initiatives. So what do we price things at, and how much credit do we extend? How much inventory do we have? And do we proceed with a product or not? So finance impacts all of those decisions, and you can see kind of how that might roll up in a mid-sized company here. We're going to talk a little bit, set the stage. I'm not going to spend an inordinate amount of time on it, but we're going to set the stage on some primary business forms of organization. You've got a proprietorship, which is really one owner, unlimited liability. So that one owner, essentially, it's Ed's Flowers, and Ed has his flower shop, and I put it all in my name, and my money's their money, and it kind of goes back and forth. And if that business undertakes a debt, it comes back to me, and conversely, all those profits come to me as well. And so there's unlimited liability. I own 100% of it. Proprietorships used to be the most common way that businesses were established. They're no longer, because of that unlimited liability. Anything goes wrong, someone falls and or eats a flower, and the flower is deadly, and they sue, it can come back on me personally. They could take the house and car. The other is a partnership. So that's if I've got Ed and Joe decide to have a flower shop. Partnership also has unlimited liability. So anything Joe does, if Joe says, hey, I'm gonna undertake this debt, that debt could be repaid by both me and Joe. Joe binds both of us, both the partnership as well as the partners. Partnerships don't have to be 50-50, but the default is that it's split up evenly amongst the partners unless there's a partnership agreement. But it's unlimited liability. Normally should have a partnership agreement, and the partners collaborate on those decisions, and the decision-binding partner binds the rest of the partnership generally. Then you've got a corporation. Corporations are, and I've got some slides on each one of these. Corporations are a limited liability organization. So if a corporation goes bankrupt or loses money, they can't come after me or my house. They're limited to the assets of the corporation. So here's a few advantages and disadvantages. Advantages of proprietorship: again, ease of formation. If I say it's Ed's Flowers, I'm out in business. It's Ed's Flowers. You may have some local licensing requirements, but that's about it. There's very few government regulations. You file the tax return on your own taxes. You file Schedule C or Schedule CEZ, and so there's no double taxation. We'll talk a little bit about double taxation later in the course, but conceptually, when you get profits, it goes on your tax return and as an individual, and you get the money. So it's only taxed at the individual level. Limitations are you've got unlimited personal liability. So like I said, if things go bad, they can take your house. it's got a limited life. If I die, the business dies. So there's no continuation of a proprietorship after the proprietor leaves the business. Transferring ownership is difficult because the assets are the owner's assets, and so you can only do an asset sale. You can't just sell the business. You've got to sell the assets of the business. And it's difficult to raise large amounts of capital because you can't bring in other investors. I mean, that's the only way to raise capital is loans. Otherwise, you turn it into something else. You turn it into a partnership, or you turn it into a corporation. And so it's difficult to raise large amounts of capital. You can get loans, or you can put your own money in it, but that's how you get capital in a proprietorship generally. In a partnership, it's just like a proprietorship, except you got two or more owners. So a lot of the same benefits and challenges. It has roughly the same advantages and limitations as proprietorship. It can raise more capital in a proprietorship because you have more owners, so you can go to more people and go, hey, give me some money. If you give me some money, I'll make you a partner. And so you can add partners, so it doesn't need to just be two people. It could be hundreds of partners. And big law firms and accounting firms are structured, or historically were structured as partnerships. And so each one of them can put in additional money. So you can raise more capital, but it's not all yours. It's now split amongst everybody else. In a corporation, which is now the most common form, and there's traditional corporations, which you might hear me call a C Corp. Then you've got corporations which are taxed like a partnership. Those are S Corps. And then you've got limited liability companies, LLCs, which look a lot like a partnership and are taxed like a partnership and tend to act like a partnership but have limited liability. In all these cases are legal entities, so you have to file with the Secretary of State of whatever state you're in and set it up and have articles of incorporation or articles of formation. There's advantages. It's got a limited life, so I can die, but if I have an LLC, that LLC continues to go on because it's considered a person for the purposes of the law. So it has unlimited life until you shut it down. It's easy to transfer ownership, and you see this like on the stock exchange. You're buying and selling shares of a corporation, and you can do it instantaneously, and depending on the structure, it can be very, very easy to do. There's limited liability, so if I own stock in IBM and IBM goes bankrupt, they can't come after me beyond my investment. So my liability is limited to the amount that I've invested. That's the most I can lose. It's easier raising capital because you can issue stocks and bonds, and so if I can go buy stock, if IBM wants to raise money, they can go put out a public offering, a secondary offering, or an initial public offering, an IPO, and they can issue stocks or they can issue bonds, which are like loans, and so you can loan money to a company and essentially buy a bond, and you give the company money, they give you back a bond, which is essentially an IOU, and it's easier to raise money that way. So they could raise equity or debt. Disadvantages: you have a lot of reporting requirements. You have separate taxation, and so you have separate taxation, and so as a result, you've got not only does the company pay money, pay taxes generally, and again, there's exceptions, and we'll talk a little bit through that later, but so if IBM makes $1,000, IBM has to pay taxes at, it's called 30%, so they got to pay $300 in taxes. Then if they send the remaining $700 to the shareholders then have to pay tax on that at their personal income tax rate, so that may be another 30%. So they may have to pay another $210. So the amount of actual profits on $1,000 that isn't taxed and actually flows into the pockets of the shareholders might only be $490. So there's double taxation, and so as a result, some of the structures like S corporations or limited liability companies were structured to avoid double taxation. But we're going to talk about, when we talk about corporations in this class, we're generally going to talk about a traditional, what's called a C corporation or a traditional corporation, where the corporation pays taxes and then any amounts that it gives to its shareholders as owners are considered dividends, and those dividends are also taxed, and that's called double taxation. We talked a little bit about these hybrid forms of businesses. So you've got limited liability partnerships, limited liability companies, and S corporations. These hybrid forms, the biggest thing about them, as I just mentioned, is they avoid double taxation. Essentially, they're structured as a partnership or a corporation or kind of a hybrid partnership corporation. So limited liability partnership feels like a partnership, except there's limited liability and you filed with the Secretary of State, but it acts and behaves like a partnership and it's taxed like a partnership. You have a limited liability company, which is kind of a hybrid between a corporation and a partnership. So you have members in a limited liability company as opposed to partners. You tend to have member interests or member units, which kind of feel like shares of stock, but it doesn't have a lot of the same corporation requirements for meetings, etc. And it's a hybrid, and it can be taxed as either a corporation, as an S corporation, or as a partnership. And then you've got, or as an individual. And then you've got the S corporation, which is taxed as a subchapter S corporation or a chapter S corporation. It can have no more than 100 stockholders and has limited liability. So when a business is organized as a corporation, we look to maximize value. And how do we do that? Well, we limit the liability. And so as a corporation, limited liability reduces risk, and the lower risk is, and we're going to spend a lot of time on this during the course of the semester, that causes market value to increase. And you'll see how that works when you look at risk equals discount rate, and lower discount rate equals higher value. And again, you're going to hear that type of discussion throughout the course, but just remember, the lower the risk, the more something is, the more valuable something is, all other things being equal. Corporations have an easier time of raising capital, so you can grow quicker. Ownership is easily transferred via stock transactions, so investors are willing to pay more for a corporation because they know they can get in and out. There's a little more liquidity. Sometimes, even if it's a private company, you've got a little more liquidity because you can sell private company easier than a partnership where you generally have to negotiate your way out. And the goals of a corporation. The primary goal of a corporation, there's a lot of discussion that can be had around whether this is right or wrong. And some of those are, part and parcel of the discussion around the presidential election this year. This might be one of the areas, if you're going to do some extra credit, might be interesting for that second extra credit assignment. The primary goal of corporation is stockholder wealth maximization, which is the same as maximizing stock price. And again, there's arguments to be made whether that's maximizing stock price today, whether that's maximizing stock price over the long haul. What does the long haul mean? In theory, the two should be the same, because the long haul should just represent the expected future value of those cash flows discounted at a risk rate. And we'll spend a lot of time talking about that, but you're starting to hear these concepts over and over again. But the primary goal is stockholder wealth maximization, which is maximizing the stock price. There's managerial incentives and wealth maximization, so you want to make sure that the goals for the managers are aligned with the goals for the organization or the ownership. And so there's normally managerial incentives, whether that's stock options or bonuses or other things, to align the management with the goals of the ownership. You've got social responsibility and wealth maximization. So again, there's a discussion around how much social responsibility and how should the organization operate as a good corporate citizen at the national level with its workers, with the communities in which it sits. And so there's social responsibility and wealth maximization as well. We talked a little bit about this, but managerial action. So if you're working in a corporation, how do you maximize stockholder wealth? It's the decisions that you make around capital structure, which is how you finance the business. So how are the firm's assets financed? Capital budgeting decisions, and I talked a little bit about this earlier. What assets should the firm purchase? What investments should the firm make? Dividend policy decisions, so how much of the firm's income should be distributed or paid to stockholders, and how much should be retained in the business to help grow the business. And again, this is something that is real life stuff that you'll deal with every day, whether you're in the finance organization or not. And so here it is a little bit more visually if you're in the charts. You've got economic factors and considerations, so economic conditions, government regulations, you've got the firm factors, and you've got investor factors. So the market factors drive how the firm and investors operate. And then those things drive down into the net cash flow, so cash flow with a hat over the top of it, and the rate of return, which is your risk. So you can see on the investor side, you've got income, age, risk, attitudes, and preference. And the combination of cash flow and rate of return determine a firm's value. So the value of a firm, and again, you'll hear it over and over, the value of a firm is the present value of expected future cash flows based on the return demonstrated by investors or demanded by investors. So the required rate of return, R, which is dependent on the risk associated with the firm. So present future cash flow or expected future cash flows discounted by the expected rate of return equals the value. And that's the value of the firm, that's the value of any asset. And any asset should be able to be reduced to this function. There's a number of factors influenced by managers that affect stock price. That includes projected cash flows, so how much cash flow is going to be coming off, the timing of the cash flows, the risk of those cash flows, so how risky are the earnings, the use of debt, so capital structure decisions, and dividend policy. So these factors are generally set by management and approved by the board, and they're going to be ways that influence both the risk of the firm and the cash flow from the firm to the shareholders or to the owners. Then you have agency relationships. So this isn't kind of what you think about as agency relationship as an agency per se, but it reflects the fact that owners hire management to run the business. So when you think about a company like Amazon, well, Jeff Bezos is in management as a chief executive. He owns only a small percentage of Amazon. The bulk of the owners of Amazon are institutional investors and pension funds and other people, and they hire the Jeff Bezos and the entire management team at Amazon to run the company for them. So you've got an agency relationship where the owner hires the agent. So the owners hire management to act on their behalf. And agency problems result when you have management making decisions that don't align with the owner, or ownership making decisions that don't align with management. And so the goal is to make sure that you have alignment between agents and owners. Stockholders versus managers. Managers are naturally inclined to act in their own best interest. We all are. And stockholders want them to act in the company's best interest. So you have to have mechanisms or incentives to motivate managers to act in the shareholders' best interest. So you have to align those things. So that's going to be incentive compensation. So I mentioned this already. Stock options, bonus plans, etc. You have shareholder intervention. So sometimes the shareholders will come in and go, we're firing management starting over. And you just saw this in the last month or so with Boeing, where they exited the CEO after the 737 MAX crisis. And that was driven by shareholder intervention. Stock price going down, the board, as representatives of shareholders, intervened and fired the CEO. That happens more frequently than not. You have a threat of takeover, and so if the firm begins to decrease in value below its potential, then other companies may come in and make an offer to buy the company, and so management would then get thrown out. And so those are ways that are forcing functions to keep management and ownership aligned. And the last couple things we're going to talk about is business ethics. So ethics is the standard of conduct or moral behavior. Ethics and legal requirements are two different things, and ethics are a higher standard than what's permitted. So legal is what's permitted, and if you don't perform legally, you can get in serious trouble, go to jail. Ethics take it another level, and really, St. Martin's is a Benedictine school, and we have a set of Benedictine values that we adhere to. And those values essentially start with treat everyone as Christ. So treat everyone that you deal with as someone that could be really, really important, and you treat them the way that you would want to be treated. So it goes back to the golden rule. And ethics is a standard of conduct that's beyond just the legal conduct. And if you think about, again, our the Benedictine values that the school espouses, and you think about that value of, treat is hospitality is one. And when you dig into it and you understand the story of St. Martin, and this will be the only time that I really dig into this piece, but if you think about the story of St. Martin, the legend of St. Martin was that he saw a beggar on the side of the road and there was a blizzard and a beggar was freezing to death. And so St. Martin, who was a Roman soldier, cut his cloak and handed part of his cloak to that beggar, so that the beggar could essentially warm themselves. And then when St. Martin went on to where he was headed and went to bed, he had a dream, and that beggar came back in his dream and essentially said that he was Jesus, and that St. Martin had given his cloak to the beggar, and he had really given it to Jesus, and that was an awakening for St. Martin. He then left the Roman army. He became a monk, and really was part of the foundations of Western monasticism. And so the Benedictine tradition started with St. Benedict, but went before that to St. Martin, who preceded St. Benedict, and with the admonition to treat everyone that you see or that you meet as if you were dealing with God, or as you were dealing with Christ. And so if you think about ethics that way, it's going to put you on the right path. And a lot of times when we've looked at ethical lapses, it's been in the finance area. So when you think about things like the 2008 financial crisis and the housing crisis and the S&L crisis, a lot of this revolves around money, revolves around finance. We tend to be overzealous with respect to the pursuit of money, and finance underpins all of that. And so business ethics is really important in the financial setting. Business ethics is a company's attitude and conduct toward its employees, its customers, its community, and its stockholders, so its stakeholders. So again, where you may have a principle of optimizing profit or optimizing share price is the principal purpose of a corporation, it needs to do that in an ethical way. And so business ethics are really how you conduct yourself within that environment in order to optimize that cash flow, or in order to optimize that stock price. And again, when you think about the fact that non-ethical behavior creates risk, and risk, all things being equal, makes a firm's value go down, it's actually in the best interest of the firm to act ethically, reduce the risk of unethical behavior, and that will, over a long period of time, improve the value of the firm. Corporate governance is a set of rules that firms follow when they conduct their business. As a result of the 2002 Sarbanes-Oxley Act, which came up after the failure of Enron in 2001, firms have substantially revised their corporate governance policies, and they've been tightened up significantly to prevent self-dealing. And so you've got good corporate governance generally has historically, and there's been tons of studies on it, higher returns to stockholders than poor corporate governance, and that includes having independent directors, having a code of ethics that you actually adhere to, having a way to hold people accountable to both the shareholders and to the communities that they serve. So corporate governance is a very important element, and it's one that underpins higher returns. So, the bottom line of the last two slides is you do not have to sacrifice ethical behavior. You do not have to sacrifice. You don't have to sacrifice being good for doing well. And so the two work hand in glove, and there's plenty of studies that show that if you behave in a ethical way, that the returns follow that. And generally, when you behave in an unethical way is when you tend to have corporate problems. There's forms of businesses in other countries. We're going to talk a little bit about international business as we move through this course. But if you have interest in international business, there's other courses that'll go deeper. Foreign firms have higher concentrations of ownership. The United States and our stock market is among the most liquid and largest in the world. It is the largest in the world, and it's among the most liquid. And almost all of us have investments in stocks. If you own a mutual fund, you invest in stocks. In Europe, companies tend to be larger, and they also tend to be more concentrated in ownership. And you can see this in Germany, where they tend to be closely held, Japan, and with the Keiretsu, and Korea with the K-Ball, where they essentially have interrelated family-owned businesses that are extraordinarily large. Here, that's not the case. Foreign firms have different relationships with financial institutions. So, for instance, in Japan, you've got Mitsubishi Heavy Industries, you've got Mitsubishi Bank, and so the cross ownership is very common. Here in the United States, it's almost prohibited. Multinational corporations, there's 5 reasons that firms go international. 1's to find new markets. 2 is to find raw materials. 3 is to seek new technology. 4, which tends to be where historically firms have offshored from the United States, is to seek production efficiency and to avoid political and regulatory hurdles. So as cost of labor or cost of production goes up in one location, companies tend to go international to find production efficiency or avoid regulation. But they also will go to new markets. So a lot of the U.S. movement into China, for instance, U.S. companies moving into China has been because you have 1 billion people that are of growing wealth, and so you want to access a market. Same thing with India and other areas where you've got the ability to move into companies or move into countries to grow your market. A lot of the Chinese have their Belt and Road Initiative, and while that's not a multinational corporation, it's similar in that they're moving into areas of Africa and Asia to seek additional raw materials to help facilitate their manufacturing. A few factors that distinguish domestic from multinational firms: different currency denominations. So if you're a domestic, you're going to be all in dollars. If you're multinational, you may be in dollars, euro, yen, pound sterling, yuan. So you're going to have different denominations. Every time you cross a border, whether that's state borders or international borders, you've got different economic and legal ramifications and regulations. You've got language differences, cultural differences, and don't underestimate the value of or the importance of language and culture in trying to work internationally. The role of government. The United States is relatively deregulated when it comes to business. I've run multinational companies before where we had offices in China and we had offices in London and Sydney. Very different environment and role of government in things like employment and taxation is very different than the United States. Political risk. So political risk is a risk that things change. So again, when you think about the United States, as much as we've seen change from 2014 to 2020 with a change in presidential administration and regulation, the political risk here in the United States is relatively low relative to some countries like India or some of the sub-Saharan African countries where you may have significant changes in regulation over time, where governments are swept out and the regulatory environment changes very quickly. So again, political risk is an important one to factor in. That fairly well covers it for Chapter 1. Stay tuned for Chapter 2, where we'll start diving into more of the deep diving into some of the more financial areas.